What's up, everyone? Thanks for tuning in. Thank you guys on the YouTube live stream for waiting for a little bit. We always kind of kick it off early so everybody has time to tune in. For you guys that signed up for the Zoom webinar, welcome. You guys get the premium treatment because you get the live version, and the YouTube guys get thanks for and the YouTube guys get a little bit of a delay. Like they're like 30 seconds behind everything. So you guys will get to throw questions first. We have about like 20 or 30 minutes worth of slides, and then a bunch of time for questions around how this process works. So yeah, I'm very much a fan of more interactive sessions than just like me talking at you for a half hour. Okay, so let's get started. My name. Oh no, this is not right. Hold on. We have a better version of this that sometimes works, which is like the little window thingy. Maybe that works. Okay. So, hey, what's up, everyone? Again, my name is Caya. I'm one of the founders of Slidebean. A lot of people think that that Slidebean is some sort of nickname for me. It isn't. I'm just one of three co-founders of this company. So, and then what we do is not just a YouTube channel. Is we actually help founders navigate fundraising. We've been around for about 12 years now. We have this platform that becomes a bit of an all-encompassing toolkit for founders that are trying to raise money. And hopefully we can do a little bit more of that through this video. Because I very much believe that raising money sucks. We're a venture-backed company. We've raised a couple rounds of funding. This is my second company, so I've tried to do that once before, even before Slidebean, and it sucks. Raising money sucks. I hate it, but I think I would have hated that whole process less if I would have known a few things. So I'm gonna try to transfer that information to you today. Okay, so the first thing I want to get out of the way is like funding often starts to feel like the end game, right? Like we work as founders, we have to spend so much time, so much so much time fundraising, right? So much time on this that we start to think like this is the goal, like this is what we're working for, right? Just trying to, just getting to investors. When in reality, it isn't, right? But let's understand the end game of a tech company, the end game of a startup, and how funding plugs into that. Now, the ideal outcome for a tech startup company is either the company gets sold or the company IPOs. That's what investors are looking for. That's what everybody's looking for. That's what we as founders are looking for. If you want to call yourself a serial entrepreneur, which is not, which is a thing, right? The idea is you'll work on this company, you'll build it, and then you'll leave and you'll build something else, which is exciting. Having run Slidebean for 12 years, it's not any job that you can do for 12 years. It's a third of my lifetime. So, well, yeah, I mean, and I guess the question has come up already. It's like, okay, well, how do profits fit in here? Isn't the purpose of building a business to make revenue? I'm sorry, to make profits. And the answer to that is yes and no. And for your investors, probably no. So let me tell you why no. Let's use this example. So let's say like this is a $1 million. Let's say that you want to raise a $1 million funding round. Cool. It's a good round number. You've maybe run some napkin math. You understood that that's the amount of money that you need. And then how much are you guys willing to give investors for $1 million? What percentage of your company? Most founders will probably land at something like here, something like in the 15% range. And it's not a crazy assumption for a tech company. Uh, a first round of $1 million could translate into about 15% equity. Maybe closer to 20, right? So I'd say 15 to 20, but this is not a crazy assumption. So let's say that investors are getting their 15%. And let's say that you take this $1 million and you start building an exciting yet profit-focused company, right? So, you start scaling, you don't raise money again, and then your company hits maybe $10 million in annual revenue, which is no small feat. $10 million in annual revenue is a shit ton of money. Okay, great. So what does that mean for investors? A few years later, right? This doesn't happen right away. So a few years later, you've raised this money. What does that mean for your investors? Well, most companies operate on an EBITDA, so earnings before interest taxes, of about 10%, right? That's pretty standard. So let's say that you kind of fall within that category. You make about 10% in profit after paying for everything, which translates into about 8% after corporate taxes, right? You're at least in the US, corporate tax 21%. So you take that out of the EBITDA, you end up with something like 8%. That's assuming that you don't have any other loans or any other issues, just like $800,000 out of the 10 million, $800,000 become pure profit. Great. That's exciting, right? Bunch of money, almost $1 million clean profit. So what do you do with that? Well, you have to give 15% to your investors because they own 15% of the equity. Well, but that means that they get back from this $10 million company, $10 million a year revenue company, from this $1 million investment, they'll get $120,000 a year in profits. So that's, I'm sorry, that's before their individual taxes, right? There's a double tax situation going on because they have to pay taxes on their dividends. So basically, for this company, at the very, very least, for this investor, at the very, very least, it's going to take 9 years operating at $10 million in annual revenue. It's going to take 9 years for them to get back the $1 million that they invested. 9 years, and that's assuming the company doesn't flunk. That's assuming that the company succeeds. And that's taking into account the ramp up. That's not even taking into account the ramp up period to get to $10 million in revenue, right? So where's the ROI? Like how does this investor? I gotta move my face. How does this investor make that money back at some point? When does that even happen? Right, and that's the reason, and that's I think a common misconception with funding rounds that hey, you're looking to build a profitable business, great, but that's probably incompatible with this idea of raising $1 million for 15%. Big common misconception with founders. A good reason why a lot of funding rounds don't happen. Okay, so let's go through another example. Sorry, to your question, Emmanuel, dividends is just like what you pay. Like the profit. Normally, a company takes in all of the profit that they made and they pay it over to their investors, to their owners. Not all the dividends. Sometimes the company keeps a little bit to reinvest and whatnot, but this is assuming everything that the company made in profit gets paid to investors. Okay, so that's not really working very well for the investors. So let's maybe try a different scenario, right? Let's go with scenario two. So scenario two is also a company that raised $1 million in funding, is also a company that gave 15% equity to those first set of investors. But there's a big difference. This company is not going to look for profits. This company is just going to go all in on this aggressive startup story that we're so accustomed to. So this company will raise more funding, right? Let's maybe, just for example, they raise another round. It's about 25%, an extra 25% of the company. That means that the share that these original investors got shrunk to maybe 12% because they keep raising money, right? And that share might keep shrinking. Usually shrinks a lot more. But because this company is not focused on profits, because they had another capital injection coming in, right? They had more money coming in. Then that means that they're going to grow a lot faster. They might get to $50 million in annual revenue. No profits though. They maybe lose money. They still burn money because they're so aggressive about their growth. They're so aggressive about their marketing and sales. They have a big product team. Their product keeps improving and whatnot. So they hit 50 million, but they don't make a single dollar in profit, right? It's just they need investors' capital to keep surviving. But this company that scaled really quickly, that built some really cool tech, well, maybe it's interesting for other businesses to buy it out, right? So maybe a bigger company comes in, looks at what they're doing. They may be competing. They may be creeping up their turf. They may be interested in the technology or the team or what they built, and they're like, hey, like you guys are growing fast. I'm gonna buy you. I'm gonna acquire this company outright. And then it's not crazy. It's actually common to see a SaaS company, a tech company, be valued at a multiplier of their revenue, right? Not a multiplier of their profits. Not even taking into account their net income, but a multiplier of their revenue. This happens. This is real. This is how companies get actually valued when a company is buying them out. Yes, the fact that they're not profitable plays a little bit of a negative aspect, but if the company is growing fast, there are always going to be more investors that are willing to put their money in. Why? Because the potential for a sale is very exciting. So this bigger company comes in, buys it out, pays 5 times revenue, which is again not a crazy valuation. And that means that investors are going to get 12% of that because they own 12% of the equity. So in this company's story, these investors that invested $1 million got diluted. Now they own only 12% of the company. They're still going to get paid $30 million, the 12% of the 250 exit. And man, that's freaking exciting, right? That's exciting. That means that they 30x'd their investment in this short period of time, about 7 years, right? So that 30 times return on your investment. This is exactly the reason why venture capital investors invest in startups. It's not because it's easy. It's not because it's safe. It's because there's an odd chance that the company that makes it will make it big, right? Like the example of, Gary Tan did a podcast a couple years back on his investment in Coinbase, right? So his investment in Coinbase, which was very early stage, had a 300x ROI. That's it, right? So an investor can be wrong a bunch of times, but if they're right about one of these companies, they'll make up for all of those and they'll multiply the revenue by 30,000 or 30x, right? So again, startups, I mean, but this path, right? This path of really fast, really aggressive growth is very risky. It requires this super fast growth because you need new investors to kind of keep fueling this fire. It's probably a path that doesn't translate into profits anytime soon, right? The big focus is expansion, not necessarily profits. You're going to need to go through more investors. You're going to be diluted by that. And then the end game is an exit or an IPO. And if that's not the path, if that doesn't happen, then it's not a very exciting business for investors, right? And that's a big difference, right? I get the occasional founder that's looking to raise money, and they're like, oh no, like who you don't have to answer the question like who's going to buy your company. That question you don't have to answer at the beginning of the company, but you kind of hear a founder say early on, it's like, hey, oh yeah, we're building this company, it's very exciting, blah blah blah, and we want to, no, I don't want to sell it. I'm going to run this company, forever. It's going to inherit it to my kids or something. Big red flag, right? Because if you're not selling the company, investors are never going to make their money back. So an important distinction. That's not to say that you have to sell the company. No, you can still build a company, not sell it, except it's not a company that can raise venture capital. That's the difference. Okay. So we established that funding is a means to an end, right? And then we established that because of how fast these companies need to scale, we're going to have to go through a bunch of different funding rounds in order to accomplish that. So those rounds have, at this point in our life, right? This wasn't the case 10 years ago. If you look at the rounds, maybe not 10 years ago, 20 years ago, right? If you look at the dot-com bubble rounds, like the first round that a company would raise was called a Series A because A is first in the alphabet, right? That nomenclature has changed. It has evolved a lot over time. So now we kind of have today, at least, this is probably going to change, but today, 2025, we have this more or less structure of what rounds mean, what each round means, size, amount of money, etc. And then that's what I want to walk you guys through because a lot of people get it wrong. If you find an article online on rounds of funding, and that article is pre-COVID, right? It's 4 years old, 5 years old. It's totally different, right? So like the sizes of rounds and the requirements to raise a round are changing all the time. Mustafa, I see your question, but I'll get back to it because it's a bit off topic. Okay, so let's go through this cycle. I'm gonna explain kind of like the case for a standard tech company, right? So standard tech company is, a software company that's building a product. It's a tech team, 2 or 3 founders. They're building a product they can launch, within a short amount of time, B2B or B2C, doesn't matter. There's another type of company which I'll get to, but then that type of company, big common misconception is that it's a company that founders go on, they bootstrap, like they build on their own maybe, and then they launch it, and that's when they go to investors, right? Just right after they launch the product, they put the product on the market and they start pitching investors. That's the worst possible time to try and raise money. You don't want to raise money there. In reality, seed rounds in this day and age happen when the companies hit somewhere into $20,000 in monthly revenue. That means that this company launched a few months back, started scaling, is now at 20K. That's when you go out and raise a seed round. That's the standard requirement for a seed round in this day and age. For a Series A, another example would be, normal, common Series A milestone today is about $2 million in annual run rate, right? So your annualized subscriptions as a SaaS, um, yeah, make up 2 million, so about $160,000 in monthly revenue. That would be the standard for a Series A today in this kind of standard tech company. Even if you're not a SaaS, if you're like a marketplace, right? It's not $2 million in GMV, but it may be about $1 million, $2 million in actual revenue for you in gross profits, right? So maybe $20 million in GMV based on a 10% commission. But that's more or less the standard today for Series A. So again, I'm talking about standard tech companies. There's this other type of company that I like to call R&D tech companies. To me, an R&D tech company is kind of like it'd be like if you're a team of PhDs that's developing a new LLM, kind of like OpenAI did, like one of the co-founders of OpenAI that left the company, started a new business, raised like $1 billion. That's a crazy round, but point is like they're not gonna be abiding by this because they need many months and hundreds of millions of dollars for their product to ever see the market, right? So like big R&D projects, biotech, hardware companies, I think are another example of what I like to call R&D tech companies. And those don't operate the same because again, you normally need many rounds of funding and a lot of money, a lot of capital early to get to a point where you can launch. So they don't follow the rules of a standard tech company. But those are very much exceptions. And I always generally just talk about the standard ones because that's what most of us are building. Again, hardware, deep tech, PhD, a lot of research, patents, etc. Like those are the ones that would normally fit in the other group. But okay, like we said, a round of funding in the end, kind of becomes a bit of a bridge, right? So we raise one round, and then the important part, if you get one note out of today's session, is when you raise money, you raise money to get to the next milestone, right? You raise money to get to the next fundable milestone, and that's it. It's not, and if you fall short, right? If the money that you raise is not enough to get to the next fundamental milestone, you might be a little bit in trouble, right? Because if you run out of capital kind of halfway around here, right? If in the middle of pre-seed and seed, if you run out of capital, you're in this bad position where you're not one or the other. Investors don't see an upside in investing because maybe you launched a product but you have no traction. So well, this product is maybe a bad product because you don't have traction, whereas it maybe you don't have traction because you run out of money, right? So it's important to really estimate how to, how much that money is going to last, and to make sure that the money they raise is enough to reach that milestone. So let's talk about what those milestones mean. So let's do, for example, the first jump here, which is pre-seed to seed. So what's a pre-seed company in this day and age, 2025? So a pre-seed company is normally a team that is fully formed. If you're building an app, right, that's the full team to build this app, right? So we're talking skills. We're talking obviously a CTO that can do front end, somebody can do front end, somebody that can do back end, some UX design because you want the app to stand out, to be beautiful. You want somebody who runs the company, right? An operator, sort of like CEO type of persona that goes and is in charge of fundraising, running the business, make sure that you run out of capital, right? And if this is a B2C app, kind of like a social media, you probably need some really strong marketing skills too, right? So 5 core skills that you need to build an app. That doesn't necessarily mean 5 different people. Can you see my hand? I think so, yeah. Yeah, it doesn't necessarily mean 5 different people. You could have a good full stack developer that does both front end and back end, so that's one person. You have the CEO persona that may be really good at marketing, and that's their background, and that's 2 people. That's done. Right? So you can group those skills into fewer people. Question usually comes up here about solo founders. I mean, it's hard for some one person to be good at fundraising and building a product and marketing and UX. It's tough, not impossible. But the challenge there is you can't do all 4 of those things, right? Normally investors are wary of solo founders because it's you kind of need someone else to have some authority in the company question your decisions, to get into discussions, and it's valuable, right? And if you're on your own and everybody else that works for the company is just an employee, then that dynamic doesn't always happen. Also, the fact that, can you really do all of these things at once? I always tell founders that people super underestimate how hard it is to raise money. Like, it's months of full-time work to raise a round. So if you're 3 months fundraising and not built product building, not doing marketing, just fundraising, who's going to do all that, right? If you're on your own. Okay, but that's a preseed company. Oh, sorry. Core skills. Oh yeah, and some plans to get to your first 100 customers. Sorry, forgot about that. Again, because your funding needs to last through seed, then you need to have a concept of a plan, an actual good marketing plan or good sales plan as to how you're going to get your first few hundred customers. Um, if you don't have that, then you're probably going to be stuck somewhere in the middle, and you don't want that, right? So those are, to me, the biggest requirements of a pre-seed. Um, so, and then the money that you raise for pre-seed needs to be enough to get you to seed, right? To get you to the next stage. So what's the next stage? Well, the next stage is having a product in the market, product launched, talked about 20K in revenue, growth, right? So ideally something like 10% monthly growth, something to prove that this company is exciting. You guys, you have figured something out about your customer acquisition, and then you're using that knowledge to scale. There's a team formed, you understand your growth metrics, and there's something going on, that there's a fire going on, that new money can come in, put fuel to this fire, and you can turn it into a really exciting company, right? That's what you need to get to in seed. So common pitfalls that would stop a pre-seed company from raising money. I'd say, trying to raise money to recruit another founder. That's not the way it works. You first find the team, you first find the founders, and then you raise money. It's not the other way around. No idea on how to get customers. Again, you're probably going to be stuck in the middle, or around that, or telling investors, "Hey, we're raising money to launch this." That's a red flag, because investors know that you're going to get stuck. Okay, so that's a bit of pre-seed to seed. Let's do the next one, right? Let's move seed to Series A. So the next phase is seed to Series A. We established what seed is. Then Series A is somewhere, as we said, about $2 million in revenue. I made that note on $1 million in ARR, because I have traumas with that number. Because when we started Slidebean, we the rule, or the instruction, or the recommendation that we got from everybody was, "Hey, you're raising a seed round, great." We raised about $1 million in seed. You're raising a seed round, fantastic. Get to, like, you should raise for 18 months of runway, right? We hear there's a lot. Um, I'd, I'd love if you guys let me know in the either chat, the webinar, or the Zoom webinar, or the YouTube chat, if you've heard this, right? Like the 18 months, say you're raising money for 18 months. I heard it. It was the standard. So that's what I did, right? We raised $1 million. I'm like, yeah, this is going to last 18 months. Great. And then when we were 12 months in, we were at about $1 million in annual run rate, 6 months from running out of money. Yeah. It's like, okay, I'm going to start pitching investors for the next round. And then I started pitching investors for Series A, sorry. And then we would get this rejection email every time. It's like, oh, well, we like what you're doing. It's exciting, but $1 million in ARR is not really Series A stage for us. We're a Series A fund, and we invest in companies with 10 million. I'm sorry, with 10 million, with 2 million in ARR and above. Maybe 1.5, but yeah, about 2. Like, okay, shit, we're here. I'm 6 months from running out of money. I don't have the money to get to 2 million. It took us a year to get to 1 million. I don't know. So what next, right? And we actually got stuck in the middle. I'll tell you more about that story if you want, but we had to kind of run through, go zombie mode, had to fire a bunch of people, and we survived by becoming profitable, and then kind of losing out on this fast scale journey momentum that we had, because we got stuck there in the middle. But again, yeah, don't make my mistakes. Make sure that your money lasts for $2 million in ARR. Series A means that the company has some good traits of product market fit, some really good understanding of their metrics, and a good established team where the founders have started delegating some key tasks and some core skills. They still obviously understand everything about the company. They still understand the metrics. They can recite them back and forth. But somebody else is running some key parts of the company, and they're you've sort of identified and proven that you can delegate some of that stuff. So stuff that would stop you from raising a seed round, the product launched but doesn't have any revenue, or you're raising money for 18 months, not necessarily to reach the milestone. It's expensive to get to $2 million in ARR. And that happens a lot. You see a company, you're trying to raise a seed, and because the market's not great, because they're in a hurry, whatever reason, they go and raise a small-ish seed. I don't know, maybe $1 million. I don't know. Seed rounds in this day and age are maybe 1.52 million. So let's say that you're in a hurry and you close your seed at $1 million. Are you sure that's enough to get to Series A? Because if it isn't, and you get stuck in the middle, it's gonna be bad news, right? You won't necessarily be able to raise another round in the middle to get to that. Anytime that you hear a round of funding called post-seed round, this concept of post-seed round, post-seed rounds are rounds that companies raise because they got stuck between seed and Series A, and they're never good news. They're usually a big hit in equity for the founders. They're usually not. They usually don't have great valuations because they're like an emergency round just to cover getting stuck in the middle. Okay, let's do one more, and then I think I'll be almost done with my slides. One more, the jump from Series A to Series B. Series B, in this day and age, probably about $5 million in ARR. It's a fully built senior executive team. That means you've snatched some hires from other from other good companies. That means you're paying them well. There's probably people in the company that makes more money than you, because you're sort of recruiting this senior exec team from Series A to Series B. At Series B, that's probably the first time where you need to have some good traits, some good ideas of what your exit strategy is going to be. Is it going to be being acquired by one of these 5 companies, or are you going to make the push to go public eventually? Normally, companies that go public have gone through Series D, E, F, sometimes. So it's still far away if that's the path. But it's a huge company, especially. I mean, right now the rules on what going public means have changed, right? And there haven't been a lot of startup IPOs recently. Iffy stock market environment. But yeah, like this is more or less the time where you sort of have to make that call or start to get ideas of what. So again, what would stop you from raising a Series A? Not enough revenue. I talked about that. Or you run out of money before reaching the milestone. Or, and this is very common, no understanding of your growth metrics. We work with companies through Slidebean in writing these texts. I think I've written something like 5 or 6 decks for Series B companies. Some decent names I have that that I got a chance to kind of get a glimpse at their metrics and kind of understand, see what those metrics are. And then a really common issue I see is that you see a Series A company that's trying to raise money, but the founders don't really understand their growth metrics. What makes a successful Series A pitch, I think, is at Series A, you've made $2 million. You've gotten to $2 million in ARR. You're going to raise a round that's probably going to be in the tens of millions of dollars. What investors need to see is a really detailed spreadsheet, financial model, forecast, where they can see how that capital plugs into this and translates into growth, right? And if you don't understand how those metrics connect and how those metrics work, those tend to be deal breakers. And I see that too often, right? I see that too often. Founders that maybe they raise money during the happy years of COVID funding, their Series A's, or their seeds. They haven't really thought about metrics. There is not product market fit is not that clear, and they struggle, right? They struggle to answer some key questions that pitch deck needs to answer. I see your questions, guys. I'll get to that. I'll just because I'm almost done with my slides. I'm gonna get to questions, but first, just talking specifically about that forecasting. Remember, we said we need to make sure that the money that we raise is enough to get to the next fundable milestone. That's super key, right? It's enough to get there. I'm doing another session tomorrow, same time, on budgeting a funding round. Now that session happens in our Startup Club channel, which is kind of like a nerdier deep dive version of the stuff that we do here in the main Slidebean channel. By the way, for you guys on the Zoom link, the same way you booked today's session, you'll find a link for tomorrow's session. But yeah, so we're doing that, another live webinar, same time. Check out the Startup Club channel. My team's gonna paste the link in your chat so you can check it out. Really good videos there, much more deep dive stuff. If you haven't checked it out, it's some good fun. Also, small commercial. We're launching a couple things around the Startup Club brand in the next couple of days, so stay tuned. So that's one small announcement. The other small commercial is just reminder that what we do, what we do here at Slidebean is we help founders navigate fundraising. YouTube is a bit of a side hustle for us. It's fun. I love it, but I think that the biggest impact that we have with companies is when we kind of work with them. So our platform, which is a SaaS tool, web-based, no one needs to install anything, is an AI pitch deck builder. We have an investor finder, a database of over 25,000 investors. We have a cap table tool. We have a financial model tool that you guys can use to forecast this stuff. It's a bit of what we're going to be working on tomorrow, in the tomorrow session. And some of our subscriptions also include monthly one-on-one sessions with our team. If you're interested in any of this stuff, you should check out Slidebean. Just go to slidebean.com. You can snatch that QR code if you want to use our code. YouTube86 will give you a discount of 50% off on any of our subscriptions. Our Slidebean Accelerated plan, if you run into that, is a subscription that includes those monthly one-on-ones with our pitch deck team, with our financials team, and includes a couple of strategy calls with me. We can talk about that. Normally, we talk about little fundraising strategy approaches. We talk about your business. Sometimes people want feedback on their pitch deck or their round, or how they're framing that to investors, how they're telling their story to investors. So I really love to get involved in that and just honestly find out what people are working on. And a bunch of people usually move from the webinar to either one of our subscriptions. So if you do, make sure to let somebody know that this session today was what brought you in. Okay, that's all the slides that I have. I'll stop sharing and I can get to questions. Okay, so I'll start with you guys. I told you the Zoom gets priority, so I'll start with you guys. Okay, so Alexander, how much should you burn on legal teams? Good question. Like, I don't think that legal expenses are too much on a day-to-day basis. I've never had a legal team on a retainer. It's usually an on-demand thing. Rounds are expensive, right? A convertible note, safe type round tends to cost, I want to say, something in the 10K in fees. Priced rounds start getting expensive the bigger they are. So we're looking at, be ready for something like 30K for a seed round. But those to me have always been the largest legal expenses. Nothing else is as large as the closing. It's a lot of equity, a lot of paperwork. What are hot markets to find investors? I don't think that there is a particular hot market. You can try our investor finder. How should investors be pitched regarding cold emails, I'm assuming, meetings or through a fundraising platform. So cold emails to investors aren't really great. I would absolutely, if I were to give you a path that you can spend a month working on to find investors, is go to our investor finder, find investors in your niche, your space, your geo, your area, and your stage, and go to their LinkedIn. So just like open 100 tabs with every investor's LinkedIn and see which investors you have a second level degree connection to. That's where I start. That's where I would always start. Intros, second degree connection in LinkedIn means somebody in common, right? So asking that person in common to give you an intro to that person, that's the way I would do it. I would not go to cold emails. I would not go to pitching through a platform until I've completely exhausted my own network. Now, if you don't have a network at all, which is rare, and it's all honestly a little bit of a concern for investors too, right? Because if you don't have a network of investors, then you're at a disadvantage against other companies. But if you don't have a network, I would encourage you to consider startup accelerators. I think that they're a pretty solid alternative to to kind of build a network. That's the way I built it. I'm Costa Rican. I don't know if most people don't know that. I'm not American. I don't live in the States. I'm Costa Rican. So when I built my first company, I didn't know anybody in startups, and I went through more startup accelerators than I should have, or than I like to admit, at least, simply because I had to bridge that gap for myself, right? So it cost company equity to create these connections, but now I have them, and whenever I build something next, I kind of fast track those connections. Okay, what else? For a pre-seed company, is there a preference advantage as to where to seek your investment? Yeah, like VCs will generally not invest in pre-seed unless they're like a super early stage fund and they identify themselves as such. We know a fund called Hustle Fund from one of our investors that um, that sorry that very intentionally invests in super early companies, but most VC funds don't. So your pre-seed rounds tend to be angel rounds for the most part. Okay, so moving to you guys on YouTube questions. Um, if no profits, I don't know if I got that. Mustafa would this be available for download after live stream? It's gonna be on. We always host these. Like the latest webinar we do is always hosted on our channel. XY, thank you. Why could they not make money of you? Never sell are There are not some private companies that are big where you make a profit, Panda Express or Raising Cane's. Yeah, like those large companies that are profitable and raised funding, these are franchises. Um, they're not tech companies, right? So they don't abide by the rules of tech companies, which means that a lot of the funding might happen through loans. And if it happens through investors, the equity stakes that they take are much larger. And that's how the investors make money, right? In startups where you're thinking of, like, think about it, right? If you're a pre-seed company, you need $1 million, you're giving investors 15%. That basically means you're putting a price on the company today of about $6-7 million. Uh, so three guys with an idea, three engineers, the three geeks with an idea. How are they worth $7 million to an investor, right? To give them $1 million in exchange for 15%, right? Something like 7 million. And the reason for that is potential for scale and potential for very big payouts, potential for very big profits. So that's kind of like how the tech ecosystem operates. But if you're a more traditional business, um, like like food and beverage, or CPG, uh, consumer packaged goods, then you can't get away with those valuations. And that's why you can't get away with those exits. You can't get away with those multipliers, 5 times revenue multiplier. That happens in tech. It never happens in consulting or in more traditional businesses. So that's why tech kind of has this edge that you can play around with these big valuations. Um, Alejandro, so hey, recently Databricks did a Series K. That's fine. I didn't know that. Yeah, I mean, I think Pinterest is another. I don't know if Pinterest is. I don't know if they're public now, but Pinterest went through like Series G as well, at least. That's fine. Like that just means that they've. I mean, it's fine-ish. I think it responds a little bit to the ecosystem where, um, you've gone through a lot of funding rounds. You're refusing to go public. At some point, you will need to, right? Because who's going to buy a company that raised through Series K? It needs to be a huge company to pay investors enough to 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 uh, to make their money's worth, right? So what huge company has cash, right? So this is not equity; it's cash to pay so much that this company was valued into. Probably none. So right, it needs to go to the public markets, and that's what happens. So I think that Databricks. I'm taking your word for the Series K. But with Databricks, my assumption would be that because not a lot of companies have gone public in the last few years, that there's kind of no um there's they've kind of gone to private markets or private investors for liquidity or for extra funding. They're kind of delaying their going public, but at this point they'll need to eventually. If I had to guess. Okay, so Arjun, can investors just sell their shares to another party even if the founder doesn't want to sell? No, usually not. Um, I mean, first of all, who would buy? So let's say that like, let's give you this example, right? So you have this company that the founder doesn't want to sell, investors want their money back. Can they sell it to someone else? Um, Normally the company has this thing called bylaws. Think of it like the company constitution, like the rule book. Normally bylaws don't allow selling shares to other parties because then that would be a little crazy. Suddenly, if, let's say that the founder is suddenly desperate for cash because they want to buy a house or whatever, so they go and sell 10% of their shares. So investors now have this new person in the cap table that owns 10% of the company and maybe has bad ideas, right? So nobody like it's bad for the company to kind of go to investors that aren't vetted or pre-approved. So that doesn't usually happen. Normally it's forbidden by the company bylaws, number one. And number two, who wants to buy shares in a company that the founder doesn't want to sell? Right? Like why would they want these shares if they know that they're going to be stuck as well? So that's kind of that's why companies go public, so that anybody can buy and sell their shares. That's the idea. Okay, New Horizons. Have you tried crowdfunding to fund your startups? How did it work out? Any tips? Good question on crowdfunding. So I'm generally not a big fan of crowdfunding, and I think crowdfunding gets this bad rep as the round that you raise when you couldn't raise in any other way, right? That kind of happens when you have companies that try to raise money from investors. Those rounds didn't work out, or they weren't able to complete those rounds, and then they go to crowdfunding. So, at least in my experience, most companies that go to crowdfunding, and this is equity crowdfunding, right? Not like Kickstarter. I actually like Kickstarter. That's not Kickstarter is not equity crowdfunding. You're just pre-selling a product, and that's fine. Um, I funded my first company on Kickstarter, funny enough. But so I'm a big fan of those guys. But no. I'm talking about equity, right? Kind of like I think Republic does that, where you sell shares of the company through crowdfunding. Uh, Again, that's normally a last resort situation, not a prestigious situation. It's not like you go to crowdfunding because it's exciting. You go to crowdfunding because you had no other choice. So it's not great news, usually, and it's been getting this bad rep. It's also not great for the founder, right? You suddenly have hundreds of people in your cap table while they don't probably have a lot of voting power or any power to make decisions. You now have to deal with hundreds of people in your cap table, right? Maybe, yeah. I've gotten the occasional um, email from, hey, like I'm your investor and I need some special treatment situation. I'm like, what? Are you my investor? How? Oh, well, I invested in 500 fund number three, which invested in you. So I'm like, I'm your invested in your company. I'm like, oh, wow, okay. And these are limited partners in those funds. They're not like retail investors, like people. So yeah, I think it could turn ugly fast, but I that's as much as I know about equity crowdfunding. Okay. Arjun, if growth is so much more important than profitability, does the financial model even need to show profits? No, I don't think so. I think that I mean, for these types of companies, um, the financial model is mostly about showing that the scale is realistic, that you understand the marketing plan and the cost of that scale, and that you're being realistic about it, one. And two, that you've budgeted enough to get to those milestones, right? That you've done your homework and you've proven that you're not going to run out of cash before you get to the milestone. Because again, nobody wants to see a company get stuck in the middle. But no, like normally a financial model that you would use in a pitch deck is not going to show any profits for years, and that's fine. Actually, if it shows too much profits, there's probably something off with the financial model. So no profits are needed in the models, at least in my experience for startups, tech startups. Okay, Jan, thank you for or Jean, sorry. Thank you for the insightful presentation. Will we receive the slides after the webinar? No, these are mine. No, no, also the slides don't make sense without my narration, I guess. Like they're very visual slides, not like self-explanatory slides. So you can just rewatch on our YouTube channel if you need to. Okay, going back to YouTube questions. And moving to the last one, to Wanashi. This is the last question I have. So if nobody else has questions, or if you have questions, now's the time to drop them. Uh, Otherwise, we can call it a day. Okay. Are there any conditions for foreign nationals trying to raise money in the US? Are you required to have at least an American co-founder? No, you're not required to have an American co-founder if you're raising money in the States, but you can't raise money. I mean, you practically can't raise money in the States unless, or I mean, you don't want to go to US investors unless you're building a US company, right? I get this a lot. A founder that's based in Africa or Southeast Asia, and they're like, "Oh, I want to raise money in the States." And like, okay, are you targeting American customers? No. Are you in the US? No. It's like, why would like that? Why would an investor invest in this company on the other side of the world with this founder that they've never met, right? That doesn't happen. There are plenty of startups per geo, and investors tend to prefer startups that they can sit down for coffee with. That has changed a little bit post-COVID, but that's still a general rule, like in their backyard. And most definitely startups that are focusing on markets that they understand, right? If you're building I met this company that was building a really cool funeral, like in Egypt, like there's like Muslim culture kind of requires you to post an obituary. At least in Egypt, that was the case, and there was no automated platform to do that. So everybody that dies needs an obituary in the paper, and there was no digital platform to do this. It's like great, like this is a tech solution. This is a perfect problem and solution. Huge market, not shrinking, etc. So I met this company in the States that were trying to raise money, and I don't think that they did, because this is a market and a problem that US investors just don't understand. So that's kind of the general idea, right? Unless you're focused in the US market, then it's not ideal to raise money in the States. And if you are focused in the US market, then you should probably be in the States, right? So as in nationality, citizenship, there are no limits to starting a company in the US. Anybody can start a company in the US, but more from an investor perspective, it needs to be uh, local, right? There needs to be a reason for you to pitch those investors. Okay. Maybe the last question. Is there going to be another webinar anytime soon? Sorry if you missed that, Tuluma. We have one tomorrow, same time, on budgeting funding rounds. So make sure to tune in. If you scroll up in the chat, you'll find the link to sign up. By the way, on tomorrow's webinar, I actually build a financial model for one or two of the companies that sign up, that tune in, especially through our Zoom. So you can tell me a little bit about the company, and then we can kind of build it live. It's more than a circus act. It's kind of proving that building a financial model is very easy. It requires some very simple math, and we have a good template that makes it a lot easier, which is free, by the way, the template. So I'm not trying to sell you on that. But the point is, it's a lot easier than people think, and it's a good homework that everybody should be doing. So that's why I kind of use that example, showing that within the span of 20 minutes, we can build a solid model for a company. Okay. I have New Horizons, and then get back to Zoom. How your team at Slidebean scaled from numbers from seed to Series A and beyond, roughly key roles. Oh man, this was a while ago. If I had some suggestions around that, I think that at seed we were small team of 4, 5. As we ramped up, we I think we became like a team of 30, if I recall. It's a huge team as we were using our seed money. We had revenue and growth. I think it was like 30, maybe 20, but I don't know, maybe 20. Yeah. Yeah, and I think it was the right decision, right? So we were expanding, we were growing, we had money in the bank. It just didn't work out, right? We didn't get to the Series A, which means that I had to fire a lot of people. I think that, a couple of suggestions around that. Don't, like prepare people for what they're signing up for, right? If people work for a startup, they should know that there's a risk, right? That you won't get to the next fundable milestone. Like, I think that, younger people are usually more risk prone, or people who are, or, there's a moment in your life when it's bad to work for a startup. If you're just about to have kids, you probably don't want to work for a startup because it's risky. And you might be out of a job unexpectedly, and that just happens, right? So there's a certain type of profile of person that works for each stage, right? people who are willing to take a lot of risks, those are founders. People who are willing to take a little bit of risk, they maybe become employee 3 to 10. And people who don't want to take risks, they only work for companies when they have 30 plus employees where things are safer. There's still some risk, but that's kind of the point. So I think that if I had some suggestions is around that time is like we promoted a lot of our employees, early employees to managers. That isn't always great. We kind of assume that people seniority translated into authority or good management skills. That's not the case. Some people are better off like doing work rather than managing people. Managing people is just another skill in and itself. We scaled. I think we started with a marketing team. We got to a team of like 4 or 5. Marketing was key for us as we scaled from seed to Series A. We maybe a little bit late started scaling the product team. Maybe that took us a little longer than expected. Customer support, office management, like kind of operations management, that sort of thing. That's kind of the order, rough order. Okay. Ranak, can we conclude that VC funding is quite essential to scale essentially when you have competition with big giant companies? That's also true, right? If you want to eat up the world with your startup and build a unicorn, you kind of have to go the venture capital route. Like you get a lot, and I see it a lot in the YouTube comments, like, hey, don't raise money, screw investors, let's just bootstrap. It's great, but you can't always bootstrap it. I'll give you an example from my personal experience. We at some point we decided we figured out there was this product that we wanted to build. It was called Recurring. It was like a SaaS tracking platform. We found the problem. The problem was real. We identified it ourselves, right, with our own experience. So we found this problem. We figured, hey, let's build a solution for this. We carved out a small team, subset team to build this product, and they spent about 6 months building it. And in the span of those 6 months, like 4 or 5 companies came out doing the exact same thing. I'm not saying they copied us. I'm sure they didn't because we were quiet about it. What I'm saying is it was a good product because a lot of companies figured out that this was a good problem to solve. But all these 5 companies were venture backed. They had millions of dollars in the bank to grow. We were operating out of profits. So we were behind. And we didn't want to raise money because we were diluted enough. We didn't want to raise money for this. And so like that's kind of another proof that sometimes speed is a variable that equity buys you, right? So that investment buys you, right? So if you can't scale fast enough, somebody's going to catch up to you. So that's another reason why sometimes, again, some founders are really anti-VCs. So just bootstrap. It's great, but not everything can be bootstrapped, especially in this day and age where tech moves so quickly. I mean, that sounds like something like a boomer would say. But I think AI is making things move a lot quicker. I've seen a lot of products be born and die in the last 2 years that are building something around AI, simply because OpenAI just launched that feature themselves, right? So I think that VC money, if you're building something fast, is almost always a requirement. Okay, maybe last question because I don't see any others. XY, thank you. What is reasonable equity you would recommend to hold up for a founder by the end of Series A? Great question, man. I have a video about this. I'm gonna find it. It's super nerdy. It's on our Startup Club channel. Let's see if I can Startup Club founder equity. I'll paste it in both chats. How much equity do founders retain? A lot less than you would expect. At Series A, very few founders, I mean, all founders together, right? Not per founder, but at Series A, it's very common for the equity stake that belongs to founders to be under 50%. That's actually very common at Series A. So founders are like, no, I don't want to lose control of my company. I want to own 51% of my company. Like that, you get that a lot. That's not realistic. Right? Like most rounds will take up that equity stake. And sorry, I'm just pasting the links. That's the link to the video I was talking about. Yeah, like the reality is that those rounds cost more than founders think. This study that was published by The Hustle and Carta, I mean, 2 different studies. They kind of talk a little bit about the study on how much equity founders are retaining after the different rounds of funding. Some really good surprising insights there if you want to check it out. Okay. 5 minutes out, no more questions. Looks like we're gonna call it a day. Thanks a lot for tuning in, everybody. Please check out Slidebean, our platform. It can help you navigate all this stuff from the pitch deck to the one-on-ones with my team, to the financial model, to the cap table tool, an actual cap table that you can use, to the investor finder. So like this is what we do. If you're not a founder and you don't need any of this stuff, that's fair. Make sure you're subscribed to our YouTube channel, I guess. And yeah, and tune in for tomorrow's session, which is going to be fun.